Hi, this is Scott Lowe. It's August 3rd, 2010, and today the Dow closed at 10,636, the S&P closed at 1120, and I would just like to go over what I feel how the economy is going to perform in the next 3 to 6 months. So it's summer. It's August 3rd, 2010, and I remember about 2 years ago during the summer of 2008, 2008 was the beginning of the Summer Olympics in Beijing. And if you remember, if you can go back to that time period, the economy was already very rocky, and we started to see the first signs of a economic slowdown. And right afterwards, right after the Olympics, it feels like the whole economy just came to a dead stop, and that's when we saw the financial crisis in September of 2008 take a hold, and we saw Lehman Brothers go under. We saw Merrill Lynch merging with Bank of America. Bear Stearns, they went out in 2007, I believe, a year before all this happened. But during that summer, it was so uncertain. You had George Bush, who already enacted a tax cut, trying to relieve the middle class and the economy, making them spend just a little bit more. And here we are 2 years later. We've had two stimulus bills on top of that tax cut, of which each one has been approximately $1 trillion. We've had the Federal Reserve rate be dropped from 5.5% to 1/4%, historical low. We've had housing breaks. We've had unemployment bills. We're having financial reform, and the Federal Reserve um, has really exhausted all of the tools that are allowed to them to relieve the American people. And Congress and the Senate, um, they're in gridlock right now because it's an election year for them, and so they can't raise taxes, and they really can't enact too many more policies in which will increase the debt burden of the American taxpayer. And so the growth rate of America will be stagnant for probably the next 3 to 6 months. We will see very little inflation. In fact, we'll probably see deflation because the growth rate won't be there. And at the same time, you have the Treasury printing trillions of dollars up in paper money, trying to, I guess, stem the recession or the economic downturn. But the problem is with all this money printing is that it's allowing the banks to borrow money at a cheaper rate, and it's allowing corporations to borrow this money from the banks at a cheaper rate. But as these corporations borrow this money and as they invest it in their business, they're not getting the expected returns that they want on their projects. And the trickle-down effect from Reagan economics, you're not seeing go down from the corporate level all the way down to the janitors, the mailmen, the mailwomen in these corporations. And these are the common people that actually spend and make the economy healthy and grow the economy at a 2 to 3% rate, quarter after quarter. And so I would say that for the next 3 to 6 months, the types of investments that I want to be in are high cash, low debt stocks, Microsoft, Intel, um, probably the midstream energy sector related to transportation, pipelines in particular. If you know anything of how the energy sector is broken up, there's three main sections. You have upstream, midstream, and downstream. And then I like to say that there's a fourth part of the energy sector. It's called the integrated, which brings all of it together. The integrated stocks, the integrated companies in the energy sector would be the Exxon Mobils, the BPs, the Chevrons, the Shells. Um, Upstream has to do with the drilling, the exploration. The downstream has to do with the refineries and the retail outlets of where consumers like you and me fill up our gas tank. And then the midstream connects the upstream and the downstream. And this segment experiences very low volatility because most of the transportation of oil, natural gas, or other commodity related fuels are based on long-term contracts, and so you're going to be seeing a lot more predictable cash flow for these companies, which would be the pipeline companies, or I guess the transportation types of energy sector companies. But I also like the international plays that pay a hefty dividend. You have Walmart, who has, yes, most of their business in America, but they're starting to buy up different retail distributions and companies in Mexico, Europe, and Asia. You have Philip Morris, which pays a 4.5–5% dividend. I think today it's trading around $52. Altria, which is another Vice stock. It's a spin-off of Philip Morris. It pays about 6%. And also like Coors Miller Lite, I think it's TAP, pays a 2.5% dividend. It's similar to Bud, BUD, the beer company. But I think that this is the sector that you want to be in. We're going to see very low inflation, and so I think right now what you want to do is preserve your capital and not be so worried about the upside in the appreciation of your stock, because you'll always be able to find those stocks that can provide an abnormal return in a regular market. But this isn't a regular market, so you want to make sure that you can preserve your wealth and limit your downside risk. And so you might want to take some risk off the table if you're able to, which is sell your stock or the cash flow that's coming in, just keep it in cash, so that when the economy tanks again, which it probably will, because I think it's valued a little too high, 10,000, we're at 636. We're probably going to breach 10,000 again, maybe 9,800 on the Dow, and probably 1050 again on the S&P. And just make sure that you have a list of stocks that you feel you want to buy into long term, so that when these indices come down again, hopefully the beta of the stocks that you want to buy in are pretty much correlated with the indices, or lower than one, beta of 1 on these indices, and you can buy these stocks. But I have a list, and hopefully you do too, and just make sure that you preserve your initial principle. Like Warren Buffett says, rule number 1, don't lose your principle, and rule number 2, don't forget rule number 1. This is Scott. Talk to you later. Bye.